Okay, so today we're going to talk about using options, specifically weekly options, to either day trade or swing trade. When I talk about, I use these terms loosely. When I say day trade, I might be referring to a trade that maybe you get into this afternoon and you exit late tonight or in the middle of the night or tomorrow morning, or I might be talking about something you get into in the morning and you get out by the close. So when I use day trade, I use it a little more loosely than most people. Most people are assuming you're getting it in and out in the same session, and we'll talk about that sort of thing as well. We're also talking about swing trading, and again, swing trading can be anything from holding from a couple of days to a couple of weeks, depending on who you talk to. In this particular class, we're focusing on the shorter term kind of situation, a couple of days, maybe a week at the most. But once we start to get into it, and I think you'll get a good idea of what we're talking about here. Of course, your time frame can be completely different. You might use different indicators or signals. You know, you may have different goals, and that's fine. So the ideas that we talk about today, you can apply to different time frames. Hopefully, I'll introduce you to weekly options and using options rather than futures to speculate in the market. So my name is Carly Garner. I am a futures and options broker. I actually live in Las Vegas, Nevada. We are DeCarly Trading. We're a branch of the Zaner Financial Services Group, who is in Chicago. The weather is a lot better here in Las Vegas, and so are the hours. We start at 5 a.m., but we generally can sneak away from the desk in the afternoon, late afternoon. So anyway, life is good in Las Vegas. If you have any questions or if there's anything that we can do for you, you can reach us here. There's our phone number. You can send me an email. I try to be pretty quick responding to emails. And if you would want to just learn more about us or you want to learn more about trading, you can visit decarlytrading.com. There's about, I want to say about 40 videos, educational videos that are absolutely free for anybody to access. If you're on social media, please check us out. My Twitter handle is @CarlyGarner, and that's Carly spelled with an EY, mostly because my mother is a terrible speller. If you're on Facebook, just search DeCarly Trading and we'll pop up, or Instagram, we are @DeCarlyTrading. To give you a little background, if you don't know who I am, I'm a broker, I already said that, but I'm also a strategist and an author. I write a monthly column for Stocks and Commodities magazine. I also contribute content to Jim Cramer's Mad Money. And for our clients, for our brokerage clients, I write a couple of in-house newsletters that are exclusively for our clients. Sorry, it's been kind of a crazy day. The newsletters offer commentary, opinions, some of them good, some of them bad, trading ideas, that sort of thing. If you want to sign up for a free trial of those newsletters, you can. Go to decarlytrading.com. Also, if you are a little more tech savvy and you like having mobile apps and that sort of thing, we do have a DeCarly Trading mobile app. It's an informational app. This particular app isn't for trading, although our brokerage clients do have another app they can use to enter orders. But this app is just for education and information. And for those that are trading with us, we distribute trading recommendations right through the app. Our clients get pop-up alerts with the ideas, all the details, the chart, the strike prices, the premiums, all that kind of good stuff. You can sign up for a trial of that service by downloading the app. By the way, you'll get 90% of the information in the app you'll get for free, whether you're a client or not. But if you want the exclusive material, which is the trading recommendations, you would need to be a client or at least be signed up for a trial of that service. So one last plug before we get started. I've written multiple books. The two at the top are the two that you should focus on. The others are from a previous publisher. They're out of print. They're hard to come by. But Higher Probability Commodity Trading and A Trader's First Book on Commodities can be found at any major book outlet. If you like what we talk about today, I think you'll really like Higher Probability Commodity Trading. It focuses on market analysis and putting a strategy together and all those sorts of fun things. Okay, one more thing before we get to the good stuff. There is a substantial risk of loss in trading futures and options. It's definitely not suitable for everybody. We're not investing. It's not putting some money into an account and watching it consistently grow slowly over time. That's not what we're doing. We're trying to beat the markets. It's not easy to do. Now, with that said, trading futures and options on futures can be anything that the trader himself wants it to be. You can approach the markets as a casino, or you can approach the markets as a legitimate means of potentially making money by, going with more conservative strategies and that sort of thing. But in any case, it's not easy and there's no free lunches. Okay, so while we're pushing forward here, somebody actually asked a question. He's saying, I've seen strike prices with bad bids and no asks for options. Can you always get out of an option contract before expiration at a fair price? Okay, that is a great question. Weekly options are a relatively new product. The CME just started listing them in the last couple of years. Depending on which market you're trading, they may or may not be amply liquid. If you're trading the E-mini S&P, the weekly options are extremely liquid. If you're trading gold or crude oil, they are getting more and more liquid each and every day, but they still have a ways to go. So the answer to that question is, if you hold all the way to expiration, which we're not recommending that anybody do that, you might run into some issues trying to get in and out of the contract towards the end of the day, going into expiration. Also, in volatile market conditions, the liquidity in the weekly options in some markets, not all, again, it depends on which commodity you're trading weekly options in, it might be an issue. But what people seem to forget is, even if you're trading weekly options, you can trade futures against those options. So for example, let's say you buy a gold option that expires in a couple of days and gold rallies like crazy. Gold rallies 50 bucks. You have a long call option. That's great. You're in the money. Things are good. But you go and you look at the bid-ask spread of your option and it's crazy. And you would never be willing to sell your option for the bid because it's nowhere near the fair value. First thing you can do is place an order to sell that option, splitting the bid-ask. Put your order in at a fair price. The market makers will, more often than not, take that fair price. In normal market conditions, they will. In extremely volatile market conditions, the market makers probably won't, because, they're not a charity. They will only take the other side of your trade if they think that they can offset the risk somewhere or get out with at least a shave of a profit. But you can always trade futures against it. So if you buy a call, the market explodes, and you try to get out of your option at a fair price and nobody will take the other side of the order, you could just sell a futures contract and you basically are locking in the intrinsic value of your option. So just be creative and understand. If you do your homework and you understand how futures relate to options and vice versa, even if the option market dries up and there's no liquidity, you can use the futures to hedge yourself or to basically lock in your gain. That's what working with an experienced brokerage firm can do for you. A lot of our clients are trading online. They make their own decisions, but every once in a while they run into a problem like that and they're not sure what to do. They can call us and we can help them, or they can send us a text or an email and we can help them and give them ideas. They're not just stuck to try to figure out how to do it on their own, because obviously those kinds of things can be stressful, and so it's nice to be able to bounce ideas off somebody and just have somebody on the outside that's not experiencing the emotion give you some guidance. So anyway, the first thing we're going to do is we're going to talk about why you should trade futures or options on futures rather than stocks or stock options. Now, if most of you have probably heard this if you've come to our other webinars, because we talk about this a lot, but we want to make sure everybody's on the same page. So I'm going to go through it quickly, but I want to make sure y'all are exposed to the information. Traders tend to flock toward what is familiar, and what is familiar to most people are stocks and ETFs, and that's because most people have a stock trading account. Very few people have a futures trading account. So the natural thing for people to do is to go where it's convenient. They already have a stock account, so if they want to trade crude oil or natural gas or gold, they look to the ETFs. They look to GLD, they look to UNG, whatever those commodity ETFs are. But that doesn't mean that they're the optimal choice. They're convenient, but they're not efficient. It's not unlike buying a loaf of bread. If you go to a convenience store, you're going to pay more and you're probably going to have less selection, and it's probably not going to be fresh. But it was convenient. If you go to the grocery store, you're going to get a little more of what you wanted. You're going to pay less, but it took a little more work. Trading commodities is the exact same thing. If you're looking for efficiency and a great marketplace, futures and options on futures are actually a better choice, in my humble opinion. but they're not as convenient because you do have to open a second account, and it does take some homework. You do have to learn, and you also have to develop a skill of managing the risk, because futures and options come with additional risk because the markets are leveraged. Why do I think futures and options on futures is a better way to speculate? You know, again, I'm talking about the best venue for speculation, not buy and hold investing. We're talking about speculating here. So if you're going to speculate in crude oil or gold or even the S&P in the short run, the futures are truly a better marketplace. And the reason being, you have around-the-clock access. You can trade futures and options on futures almost 23 hours a day in most markets. A few of the markets trade only during a day session. A handful of them trade off and on, but for the most part, most of them you can trade around the clock. Also, futures offer free leverage in a margin account. You don't have to apply for it. In stocks, you would have to apply for margin. Your broker would either deny or approve that request. Most accounts that do earn leverage privileges and are allowed to trade on margin are sizable accounts. Most brokers will make you have at least 100,000 in your account or more to access those kinds of privileges. What most don't realize is if you're buying a GLD ETF or one of the crude oil ETFs or whatever the case is, most of the time what they're doing is they're pooling money. So you buy the ETF, they take your money, they put it into a pool, and then with that pool they turn around and they buy futures contracts. So when you're buying the ETF, it's not that you're avoiding the futures market at all. You're just getting a piece of the futures inefficiently. Now, they are taking all the leverage out for you, so it does make it probably a little easier to manage for a beginning trader. Trust me, there are better ways to do it than buying GLD or something similar. You have to consider if you're trading an ETF, there are administrative costs. They have severe exposure to contango because they are generally buying contracts with deep expiration dates. So again, it just comes down to efficiency. In the futures markets, you can buy or sell in any order. You don't have to worry about uptick rules, pattern day trading. None of that applies in futures. If you want to go short, you sell it. If you want to buy it back, you can buy it back. And you could do this back and forth, 100, 200, 300 times a day if you really wanted to. I'm not saying you should, but you can. So in the futures markets, people are given a lot more freedom to speculate in the way that they want to speculate, but humans also have a tendency to overindulge, so that's where things get a little tricky. To trade futures and options on futures, you really must be able to manage your emotions and avoid making the mistakes like over trading and over leveraging and those sort of things, because nobody else is going to stop you. You're the only person that can stop yourself from doing those sorts of things. So in futures and options on futures, there's low account minimums. Our brokerage has a minimum of 2,000, so you can open with as little as 2,000. I'm not necessarily saying you should do that. In fact, I think you really want to try to shoot for 15 to 20,000 is ideal to start in a futures trading account. But remember, this should be risk capital, so if that's too steep for you, by all means, start with a much smaller amount. Start with what you're comfortable with and start with what your risk capital is. And risk capital is money that you could lose. You don't want to lose it, obviously, but if you did lose it, it's not going to ruin your life. Futures traders get to buy or sell futures, buy or sell options without interest charges. You can trade on margin without borrowing money from your broker and paying fees. And there's favorable tax treatment. Regardless of how long you hold the trade, you're going to be charged a tax rate, which is a 60-40 blend between long-term and short-term gains. So if you make money in the futures and options market, you'll pay less in taxes than you would in the stock market. Also, you don't have to worry about reporting each individual trade. You report a single figure to the IRS. You don't have to list your trades. You either made money or you lost money, and that one figure is all you report. So it's really simple to report to the IRS from a futures trading account. I know stock trading accounts are not like that. And of course, futures trading is exciting. That's why we're all here. The potential to make money is there. The potential to lose money is very real, so you have to keep both outcomes in mind. But I will tell you, I've seen some really, really wild things. I tell this story a lot because I'll probably never see anything like this again, but I did once witness a trader turn a $10,000 account into $500,000 in about 2 weeks. Sadly, he ended up losing it all plus more. And what he did was he purchased several hundreds, and believe it, in that size of an account, if I remember right, it was probably at least 100 options or maybe more put options in the S&P. He cheap, deep out of the money puts in the S&P right before the financial crisis, and he just happened to get lucky, and that was the outcome. So I can't think of any other market or trading tool that would allow someone to do that. And I'm not saying that you're going to do that. I'm not saying anyone will ever do that again. But that just is an example to show you just what kind of chaos the futures and options markets can be. Now, obviously, if you're on the wrong side of that, that's a different story. But in the case of buying puts, your risk is limited. So the most this trader could have lost is 10,000, and turning it to $500,000 was pretty good. Of course, that wasn't good enough for him, so he gave it back. Anyway. So a lot of people that I talk to, beginning traders mostly, they all want to day trade. They've got it stuck in their mind that that's the best way to go. And their arguments are usually that there's a low barrier to entry. In other words, I just told you at our brokerage, you can open an account for as little as $2,000. Most people that are opening accounts with that size are, in fact, day trading because day trading margins are low. So there's a low barrier to entry. There's no overnight risk to day trading. And by the way, right now, with this particular slide, I'm talking about day trading futures, not day trading options. We're going to get to that soon. But people are comfortable with the idea of not having overnight risk because you're in and out in the same trading session. You close your position before the close, and you move on with your life, start again the next day. And also, day trading is exciting. It speeds up profits and losses. Most people that are day trading are using the same technical indicators for intraday trading as they might use on a daily chart or a weekly chart. So it just kind of speeds everything up. Either your technical system works or it doesn't, and day trading is a way to find out. My personal opinion is day trading is the most difficult way to make money in the markets. Very few people find a way to do it consistently, profitably. I think there's better avenues, but that's my opinion. The downfall of day trading is really the same thing that drives people to day trading, and it's the flashing lights, the quick fills, it's the adrenaline. But the problem is those things usually get the best of traders, especially traders that are new. It's just too exciting. It magnifies the exposure to destructive temptations and obstacles. So the worst thing that could ever happen to a new day trader is that they make money because, and unfortunately I see this a lot, people start trading, they really don't respect the risk that comes with trading because they've just haven't traded long enough to understand how much leverage and how much they could lose and so on and so forth. And so they haven't really applied the emotion to their trading yet because they didn't know they needed to. So they come in and they start making money. I know of one trader, just this is a single example, but this happens really constantly, these types of stories. He started with 20,000. Within a couple of days, he had 60,000, and he talked to me and he said, "Is this normal? Is this how it goes?" And I said, "Absolutely not. That is not normal. Take the money, at least take out what you've made and trade with the rest." And of course, 2 days later, his 20,000 that went to 60,000 was back down to 5 or 6,000, if I recall correctly. So the problem was he didn't understand how difficult it was and didn't understand that he was supposed to be scared. And so it was easy to trade under those circumstances. But once he realized things weren't supposed to be that easy and yes, he could lose money, then the mental part of it kicked in and he started to lose. That happens a lot. It's not unlike people that make a ton of money paper trading and then, well, they make a ton of monopoly money paper trading, but as soon as they go live, the opposite happens. The same thing, it's emotional. Trading is emotional, and that is really the one thing that stands between somebody making money or somebody losing money. So the biggest thing that gets day traders into trouble, well, in addition to over trading and over leveraging, of course, is stop loss orders. Stop loss orders are meant to protect traders from large losses, but if you're getting stopped out on every trade, you're incurring multiple small losses, and those can add up really quickly. In fact, I actually believe that stop orders do the opposite of protecting traders. I think they actually work towards failure. And I know you're not going to read that in most books, most literature, or most courses will tell you always have a stop. I will tell you that you should always have risk protection in place, but that risk protection probably shouldn't be a stop order because without fail, more often than not, stop orders get hit right before the market moves in the intended direction. Anybody that's ever traded will tell you if they're long a market and they put a sell stop in, the market generally will hit their sell stop and then rally. It happens a lot. So playing with stops, especially if you're playing with tight stops, it's basically playing not to lose. If you've ever played sports, you know your coach will tell you play to win, not to not lose. And unfortunately, it's hard not to do that, but the reality is stops are detrimental to trading, in my opinion. So then there's the flip side of that. If you don't have a stop and the market runs away from you, then what? You're sitting there with huge losses and you don't know what to do. One way to eliminate both of these risks is to use weekly options in your day trading. Now, in other classes or other webinars I've done, I talk about using options to protect futures positions. In this class, we're not going to trade futures at all. We're only talking about buying calls and buying puts. And what that does is it eliminates the odds. Well, I shouldn't even say the odds. It eliminates the possibility of ever getting stopped out. If you buy a put option because you think the market's going down and the market goes up, you're never going to get stopped out. That put will always keep one foot in the door for you. You don't have to worry about stopping out and all that kind of stuff. And you know your risk is limited, so you don't have to worry about slippage. The only thing you have to worry about is paying the premium, and of course, options aren't free, so we'll talk about that too. Let's also make sure we understand what swing trading is. Swing trading is an attempt to capture market moves in a period of a few days to a few weeks. For our purposes, we're going to be referring to trades that are simply held beyond the close of a session. So for example, anybody that's day traded futures knows the rigmarole. If about the last hour of the day, you see the market squeeze higher or lower for no apparent reason other than all the day traders have to get out because they don't have enough margin to hold their position beyond the close. And so you get the herd, most of them probably losing money, moving the other way. As an option trader, you don't have to worry about overnight margin or overnight risk, unlimited risk anyway. Let's say that you buy a call option late in the day and you want to play the everybody else getting squeezed out on the close, or maybe you just want to hang on until the evening. Maybe there's some sort of news in China that you're expecting, or whatever the case is. You don't have to worry about margin. You just buy the call option, you hold it into the close, and you can sell it tonight or tomorrow morning or whatever the case is. But that's swing trading to me. So even if you're not holding it 24 hours, but you're holding beyond the close, I would consider that a swing trade. And keep in mind, like just because you hold a position through the close doesn't mean that you have to get out the next day. So again, the markets are 23 hours a day. They're almost always trading. You could go to the gym, you could eat dinner, and then get out of your trade. So you don't have to wait till the next morning. And a lot of times you will notice, because day traders are forced to get in and out at the close, markets sometimes make weird moves. And I would venture to say that if you watch the pattern long enough, you might even be able to figure out when the high probability buys and sells are according to those sorts of patterns. But anyway, you don't have to hold a trade 24 hours for it to be a swing trade. It might only be a couple hours. So we just talked about this. You really want to avoid the herd. You don't want to be the guy that's scrambling to get out of his trade at the end of the session, because what happens is you get short squeezes, you get long squeezes, fundamentals don't matter, charts don't matter. People need to get out, so price is irrelevant, and markets do weird things. If you do not have enough money to hold a futures contract beyond the close, you're going to be caught in the herd. And the way to avoid that is to either fund your account to a level that you can hold an S&P or NASDAQ or whatever it is you're trading beyond the close, or use options instead. The market doesn't care that whether or not you have enough margin. It doesn't care if you need to be out by the close. The market's going to do what it's going to do. And so if you're trading signals that aren't allowed to play out because you have to get out by the close, you're really doing yourself a disservice. Your technical oscillators and your support resistance and all that kind of stuff, they don't operate on time. They operate on price. In my opinion, it's really important that you have the ability to hold beyond the close. And again, if you're day trading in a small account, you can't do that because you don't have the margin. But if you're trading options, margin isn't an issue. When you buy a call or buy a put, your risk is limited to what you spend on those options. So there is no margin. So you can hold overnight. And to give you an idea of how important it is, the stock market moves are generally made overnight, not during the day. So in 2018, if you would have bought the close and sold the open, meaning your position was open while the New York Stock Exchange was closed, you would have made 13% as opposed to losing 6 or 7% if you bought the open and sold the close. So that's how big of a swing you can see overnight. While most people, a traditional day trader is flat. They're sleeping, they're not looking at things, so they're missing all the action. And it shouldn't be surprising if you've been following the markets for a while. You notice that Sunday evening gaps sometimes can be pretty big, or especially Monday morning sell-offs. So you can see some really big moves in the aftermarket while the New York Stock Exchange is closed. As a futures trader or an options on futures trader, you can take advantage of those sorts of moves overnight without having a lot of risk or margin using options. So the point I want to make is it's really important to be able to hold beyond the close. So if your trading situation is that you have to be out by the close, the odds of you making money are pretty slim. And I also want to make sure everyone understands that you can have the greatest system in the world, the greatest signal in the world, but the reality is it comes down to a mental game. Nothing gives one person so much advantage over another as to remain always cool and unruffled under all circumstances. I mean, even if somebody told you in 2008 to buy the S&P at 670 or 680, around the lows, and sell it at 3,000, would you really have had the mental wherewithal to just hold on tight, roll over your futures position every quarter, and hang on to it? Probably not. So even the best signal in the world would have shaken you out, and the reason being it's a mental game. The idea of trading options or weekly options is to mitigate the mental game, to mitigate the mental obstacles that come between you and actually making money. So we already talked about some of the obstacles to day trading. These are the 3 that I want to focus on: premature stop-outs and lasting power, emotion. If you're handling your emotions correctly, you're going to have less account volatility. You won't have to worry about your brokerage firm stepping in and liquidating you. Trust me, you never, ever, ever want that to be how you end a trade. You don't want your broker to have to step in and take action. And you never want to get out to avoid full margin. You want to be able to hold to the close. Once again, buying options as opposed to going long or short a futures contract will mitigate or actually eliminate all 3 of these obstacles. The other obstacle solved by this sort of, by using options is there's no margin concerns. You have lasting power. I'm not saying you aren't going to lose money. You might buy a call and the market goes down and your call loses value, but you're going to be less prone to panic, and you're not going to have to worry about being stopped out to limit your risk. You can sleep at night knowing whatever you bought that option for is your maximum risk of loss. And you can ride the waves. You're not going to always be wondering, am I wrong? Is the market going the wrong way? Am I going to lose too much money? So you have a little more lasting power with options. And with options, you're going to see less account volatility because the options don't move as quickly as the futures contracts do. Some of you might think that's a disadvantage, and then you might think that's boring, but the reality is it shifts the odds of success favorably because, again, if this is a mental game, the way to win at that game is to keep our emotions in check. Let's talk about weekly options. So prior to weekly options, traders were accustomed to working with options that expired every month. So we had, in the S&P, we had January, February, March, April, May, so on and so forth options. Most grain markets had options every couple of months, depending on the growing cycle, that sort of thing. Energies had options once a month, metals once a month. But now we're finding that the CME is consistently adding weekly options to a lot of the commodities, meaning that we now have options expiring every Friday in most commodities, and in some markets we actually have options that are expiring on Monday, Wednesday, and Friday. So you can pinpoint your speculation to a couple of days if you really need to. And this is a really huge advantage because when we were dealing with monthly options only, it was really hard to be an option buyer. If you were looking to trade, let's say there's a USDA report out tomorrow in corn, or maybe you wanted to play the inventory reports in crude oil this morning. If you had to buy an option that expired 30 days from now, you'd be spending a ton of money, and you'd be subject to a lot of time value erosion, and if you were wrong, the option could lose a lot of value very quickly, and so it was really difficult. It was almost impossible. But now, because the options expire in a couple of days, you can buy options that are relatively cheap, so you can get your foot in the door with a close to the money strike price and have a chance to make some money if the market moves in your favor. So just to give you an idea of some of the markets that there are weeklies on: crude oil, gold, grains, currencies, treasuries. The most liquid are the S&Ps, which are Monday, Wednesday, Friday. As you can see, you could really, really fine-tune your speculation with limited risk. And some of these options that expire in a day or two are really cheap. We're talking a couple of $100, and you're not that far from the market. So again, it's just a much easier tool to deal with than what it was when we were dealing with monthly options. So I like to refer to day trading or swing trading with weekly options as poor man's day trading. The reason being, you're getting limited risk and lower risk. The delta on an option is going to be lower than it is on the future. If you're not familiar with delta, it's basically the rate of change of option price relative to a futures price. So right there alone, the position that you take on is going to move slower than the future. And again, some people might think that's boring, but the reality is it will help you, your mental coping skills. So some of you are probably wondering, do the options move enough to make it worth your while? And the answer is yes. An at-the-money option has a delta of 50%. So if you buy a call option in the S&P and the S&P moves 10 points higher, that call option would have gained in value by 5 points or $250. So a 10-point move in the S&P, if you were trading the futures, would equate to $500. On the option, an at-the-money option, it's only $250. So you can see it does move slower, which is great if you pick the wrong direction, not so great if you pick the right direction, but I think you'll find it's much easier to manage. Crude oil is the same way. A crude oil option that's at the money will move half as much as the futures. So you're looking at possibly, if crude oil moves $1, you'll make or lose 500 instead of 1,000. Now keep in mind, I'm just randomly choosing deltas of 50. You can buy an out-of-the-money option with a much lower delta for a lot cheaper as well. We're going to look at some examples a little later in the class. Out-of-the-money options have lower deltas, but they also have lower risk. So if you're conservative, you don't want to risk several $100s on a single trade, you might go to some of the out-of-the-money options and only risk a couple of $100s. In fact, that's probably, with this kind of a strategy, I think that's probably the best way to go about it. You don't want to spend too much money on an option that expires tomorrow because time value erosion is going to be real. And if you pick the wrong direction, an option that's worth $500, $600, $700 today can be worth almost zero tomorrow. So you don't want to be put in that spot. The idea is we want to keep risks low, but keep the profit potential wide open. By the way, when you buy a call or you buy a put, your profit potential is theoretically unlimited. So that's the great thing too with these things. You can get your foot in the door with a small risk and a small cash outlay, and you have open-ended profit. Now, anytime you're buying options, your timing has to be really good to make money. So I'm not trying to mislead you into thinking that there's some sort of easy magic here, because that's just not what trading is. I'm just giving you a low risk, low cash outlay way to get involved in the market with a relatively aggressive short-term strategy. So if you're wondering if the markets will move enough for you to actually make money in an option, the answer is absolutely yes. The high in the S&P was about 20, I'm just going to round it, 28.40. The low was about 28.10, so we're talking a 30-point swing from high to low in the S&P. In today's market, I mean, this is from 2018, by the way, this slide, but in today's market, that really is not uncommon. In fact, we've been seeing 60, 70-point ranges here in the S&P, so it is definitely doable. It's not out of the question. But to give you an idea of how much these options can move and what your risk and reward might be, if you look at the 28.10 put, which is right here in the middle, the high of the day, I don't know if you can see this, so I'll read it out to you, but the high of the day for that option, the 28.10 put, was $10, so that's $500. The low of the day was 185, which is roughly $95. Well, it's about 90 bucks. We'll just call it $90. So that option traded as high as 500 and as low as 100. We'll just round it. So there was a $400 profit potential in there. Now, obviously, you're not going to pick the high of the option and you're not going to pick the low, but I'm just trying to give you an idea that, yes, you could have, like, let's say your timing was impeccable and you picked the very low of the day. You spent $90 on this option. So you spent $90 on the option, and a handful of hours later, you were able to sell it for 500. So that's just to give you an idea of how something like that might work. Now, it could go the opposite, of course. If you pick the wrong direction, you could lose money pretty quickly, obviously. So in this case, let's say that you decided to buy the 28.40 call on the high. You would have paid about $400 for it. And let's say that you sold it on the low, so your timing was absolutely horrible. You would have only gotten about $60 for it. So you're looking at like a $300 to $400 loss on something like that. I generally would recommend with this type of a strategy, you really don't want to spend more than maybe $200 on an option, because the premium will erode immediately if you're wrong. So if you spend less than 300, but probably closer to 200 on an option, you're probably not going to get burned too badly on one particular trade. And if you catch a few here and there, you should, in theory, come out ahead, assuming your trading strategy is sound or your signals are sound. So this is actually crude oil. So the options we were looking at before were the S&P, just to give you an idea of how they can move. This is crude oil, and this was earlier this year. The high of the day, again, I'm going to round, is about $60. The low is about 58. So it's a roughly $2 range. In crude oil, I think we can say that's pretty reasonable. I think that happens quite often. So we're not talking about a really huge day or anything, just a kind of an average day in crude oil. These options have 7 days to expiration. So this trade would be looking for a swing trade, maybe not just holding for a couple of hours, but maybe a couple of days. But just to give you an idea of how much an option like this may or may not have moved, we can look at the highs and lows of these options. So let's say you were lucky enough to buy the low on the 55 put. You would have spent roughly $200 for it, and at some point during the day, you might have been able to sell it for over 50 cents. So that's a $300 profit on a $200 risk. Again, I'm not saying it's easy to do this. I'm saying this is something to look at because it'll be a strategy that you can trade in a smaller account. You don't have to worry about margin and all those other stresses that are going to affect your decision making. You can simply go off of, what does my trading indicators tell me? Where do I think the market's going? Let's make a bet. Even if I have to hold beyond the close, it's no big deal. And you don't have to worry about stop orders, premature stop outs, all of that kind of stuff. So it's just a different way to look at it. So what turns people off to this strategy or trading options in general is when you're trading futures, it's really black and white. You know, if you buy crude oil at 55 and you sell at 56, you made $1,000 bucks. But with options, if you buy a crude call and the market rallies $1, you're not really sure how much you're going to make because it depends on time value, volatility. It depends on all types of things that really can't be quantified. So there's no easy math when you're trading options. It's a little bit of an art, and there's a little bit of gray area. If you hold all the way to expiration, the math is really simple. But at any time before expiration, it's hairy. But you can estimate what your P&L might be if you buy an option and the market goes the right way. And you can do this by looking at the high and low of that option of the day. You can look at the current value of the strike price you want to buy or sell, and then look at the strike prices around it to see what those values are. So for example, if you're looking at a crude oil 55 call and you want to know what that option might be worth if crude oil rallies $1, you could look at the 54 call and you can see, okay, the 54 call is worth 80 cents, so I think the 55 call will be worth 80 cents if I buy it here for 50 cents and the market goes up $1. Now that is just a rough estimate. You're not guaranteed that that's going to be the case. It depends on time, how quick it does it, those sorts of things, but it will just give you an idea of what you're playing for. Okay, so let me answer some of these questions real quick here. Somebody's asking if they can trail their stops like they do on futures, and the answer is no. You really can't put stop loss orders on options. I know a lot of people try to do it and they want to do it, and there are some platforms that will allow you to do it in some way, shape, or form, but the reality is, like for example, our free platform takes stop limit orders as day orders, but it's really probably not the best idea, especially if you're buying options. When you're buying options, your risk is limited to what you pay. So if you buy an option for $300, there's no need to put a stop on it. And in fact, you should not put a stop on it because you know the worst case scenario is you lose 300. If you do place a stop, loss on it or a stop limit, such as our platforms accept, you're really running the risk of being prematurely stopped out. So remember, we're saying that maybe you should trade options because you avoid the risk of being stopped out. So placing a stop on your option is taking that advantage away. So if you really want to deal with stops, then just trade the futures. Don't trade the options. Options have wider bid-ask spreads, and your stops are likely to get dinged at the worst time, just like your futures position would. So no stops on options. All right. Somebody's asking how much the commission and data fee would be. Commission depends on the brokerage firm you choose. Obviously, every broker has a different commission structure. And let me just give you a couple quick warnings. You really do get what you pay for with commission. I'll talk about this a little later, so I'm not going to go into too much detail, but it depends on the brokerage. Later in the class, I'll talk about what our brokerage charges and give you some ideas of what you should be looking for and asking for. Somebody's asking how much money that somebody should have to trade for a living. That is an open-ended question, and there really isn't an answer for that. The reality is trading for a living is extremely difficult to do. Very few people can do it, partly because we've already mentioned this is a mental game. And so if you have to make money in your trading to pay your bills, to feed your kids, that sort of put clothes on their backs, it's way too much stress. Most people can't handle it. I really don't recommend, unless you have successfully traded for a very long time. And even then, I wouldn't recommend quitting your job and trying to trade. Maybe weaning yourself off from one to the other. But again, you really don't want to put yourself in that situation. Very few people can do it. Okay, so let's take a look at an example of a weekly crude oil options trade. These are purely hypothetical, and they're assuming that maybe you buy it exactly the right time and sell it at the right time. So again, I'm not saying that this would have been something everybody and their dog would have done easily. All I'm saying is this is kind of what you would be looking for. So a swing trader, we already talked about, swing traders are looking to buy the dips and sell the rips, which is the exact opposite of what human nature wants us to do. Humans do not like to buy a market that's going down or sell a market that's going up, and that's especially true in crude oil because crude oil is treacherous, especially when it's rallying. I've seen crude oil rally $7, $8, $9, $10 in a day. In fact, actually, just recently we had a situation in which it did just that. So selling crude oil going into a weekend is probably never a good idea. But if you buy a put option, you know your risk is limited. So let's take a look at what this trader may have considered doing. So you can see right here, crude oil took a nasty dip on a Friday. This is a Friday, and it closed down here on the lows. It would have taken a lot of guts to buy a futures contract there, hoping that by Sunday night things would reverse. Further, even if somebody did do that, you'll notice the market fell down here below support temporarily. So somebody that did buy a futures probably would have been stopped out or probably would have lost sleep over the weekend, right? Who wants to see what happens on Sunday night when you're trading crude oil? So instead, somebody could have went long a $60 crude oil call option that expires in 6 days. The cost of that option would have been about $580. So that person knows no matter what happens, the most they can lose is $580. And if come Sunday night, Monday morning, crude is not up where they wanted it to be, they can get out and get some of their money back. Lucky for this guy, the market did gap higher on Sunday night. This trader might have noticed that we're up against trendline resistance, so we're at the exact opposite situation. By the way, this is a 60-minute chart, and you can see the market's trading in a range. The trader might have recognized there's some resistance there. The market's a little overbought. The trading channel resistance is holding, and so that person might have decided to sell his option and take a profit. He might have considered going short a futures contract on Sunday night to see what things would look like on Monday morning. But again, nobody wants to sell crude oil futures and go to bed, at least not without a stop. And if you have a stop, you're probably going to get stopped out. So maybe a better way to do it would have been to buy a 58 put. And notice we're picking strike prices. Like the market here is around $60. A 58 put is putting it right back here to the bottom of the range. When the market was at the bottom of the range here, we were buying a call option that was a 60 call, so right around here at the top of the range. So you don't have to buy an option that you think the market's going to surpass. You can buy an option that you think is just simply going to gain in value because the market might get closer to that option strike price. So you don't have to buy a 59 option thinking, well, if you think it's going to 60, you don't have to buy a 59 call. You could buy a 60 call. If the market does what you think it's going to do, that option will gain in value. So rather than selling a futures and going to bed on Sunday night, somebody could have bought a put for 40 cents. So for a 40-cent risk, you could have played the downside in crude oil and slept pretty well at night. And naturally, it did go lower as expected because we're in a trading range. And then that person could have hopefully taken a profit and then maybe did it again. So this is swing trading. Buy the dips, sell the rips, but we're doing it with options. So at any given time, this trader, the most the trader could have lost on this situation was 580. On this situation, it's 400. And then on this trade, the trader's only risking 400. So you notice as time goes on, when we first purchased this option, there was 6 days to expiration. Now on these other two trades, there's only 4 days to expiration. So that's time value erosion. So it's a lot cheaper to get into trades that have fewer days to expiration. Your risk is lower, but you still get to benefit if the market does happen to go your way. Okay, so this is just kind of reiterating what we just went through. The $60 call purchased for $580 on Friday's close doubled by Sunday night. The 58 put that was purchased on Monday morning, remember we spent $400 for it? That would have almost doubled in value by the time Monday morning came along. The $60 call that would have been the second attempt at the upside, it was $400 on the last slide, that one was incorrect. So maybe we got a little greedy, or this trader got a little greedy trying to play the next swing higher, but that $400 option would have lost half its value, meaning it's a $200 loss. So the first couple of trades, a trader would have doubled his risk, and then on the last trade, he lost half of what he was risking. Now again, these are hypothetical trades. I'm just trying to give you an idea of how these options will move with the underlying futures contract. If you were trading a crude oil futures, it would be extremely stressful because not only do you have unlimited risk, or if you're placing stops, you don't want to wake up in the morning to find out you were stopped out before the market dropped or rallied. Stressful. With the options, it's a lot less stressful. But with the futures, so if you would have went long a futures contract here instead of bought a call option, you could have made maybe $2,000 on this trade. You might have made almost $2,000 again, so you're up $4,000. But do we really think we wouldn't have been stopped out, or do we really think we would have been able to ride this out? We probably would have panicked and got out here, or you know what I'm saying? There's so many more questions that can't be answered unless we actually are trading it in real time. And most people get nervous and they overreact, and that's what happens. So although the profit potential for trading futures is a lot higher, the odds of you actually coming out ahead are far, far lower, in my opinion. So in this last trade, we mentioned that the option lost half of its value. We bought it on Sunday night, or I take it back. We bought it on Monday. I'm sorry. We bought the second call on Monday, and the market didn't go as planned. And in fact, the market broke below support. Futures trader would have been stopped out. An option trader might have opted to sell his option and take a $200 loss, or he might have held on. Had he held on, he would have been able to sell that option for break even, or maybe he would have felt comfortable in hanging on and hoping that we do get back up to 60 again. But it's that lasting power that really, really makes a difference. So instead of being stopped out at a loss, an option trader could have just hung tight knowing that the worst case scenario is a $400 loss. Lasting power and the ability to hold overnight and the ability to know you're not going to get stopped out is an immeasurable advantage. So if making or losing a couple $100 on a trade is boring for you, here's some ways to spice things up. You can trade multiple lots. You don't have to buy just one option. You can buy 2, 3, or 4. I'm not saying you should. Again, this is not a recommendation. This is just for those of you. I know some people just simply get bored. If they're not making or losing thousands of dollars every minute, they're bored. So this is just some ideas. Or you don't have to trade the out of the money options. You can trade near the money strikes. The options will be more expensive, but they'll move faster, and you'll get more bang for your buck if you're right. Also, if you are trading multiple lots, you can peel positions on and peel positions off and put them on incrementally. And this is actually a huge, huge advantage. Most people that manage to hang around and either trade successfully in the long run or at least stay in the game, this is what they do. They're legging in and legging out of trades because you never know where the exact high is going to be or where the low is going to be. Nobody can pick the tops and bottoms. But if you get close and you're peeling risk off when things are going good and putting risk on as things are going a little against you, you're dollar cost averaging, and generally you're going to be better off. Also, don't forget, you don't have to swing for the fence. It's not necessary. Everybody wants to, but it's really not necessary. If you made $50 a day, that would equate to $12,000 at the end of the year. So let's say you have a $10,000 account. All you have to do is make $50 every trading day, and you double your account. Ironically, that's harder to do than you would imagine, than you would think it would be. But the point is, you don't have to swing for the fence. And if you do swing for the fence, you're probably going to strike out quite often. So people really, really focus on commissions, and I get it. Commission does matter. It's baggage. But the reality is, it doesn't matter in the way that you think it does. There is so much money to be made or lost in the markets. 50 cents or $1 or $2 difference in commission is not going to decide whether or not you're making or losing money. To be honest, it has absolutely no consequences whatsoever in the long run. In fact, if you are trading with a brokerage that gives you access to weekly options, lets you buy or sell options as you please, answers their phone, trust me, that's a big one. Most brokers don't even answer their phone, answers their emails, make sure everything's running smoothly. All they have to do is save you a tick in crude oil or a tick in bonds every once in a while, and you come out ahead. So don't focus on saving money. Focus on putting yourself in a situation where you have the best odds to make money. You truly will get what you pay for. If you're trading with a brokerage firm that's charging you pennies in commission, you're going to get what you pay for. And it's probably going to be not having access to all the available markets, especially we're talking about weekly options today in crude oil, gold, grains, S&Ps, Monday weeklies, Wednesday weeklies, Friday weeklies. A lot of brokerage firms don't even show their clients that these exist. We do, but a lot of them don't. So be careful. When you choose a broker, don't go for the lowest commission. Go for the place that's going to give you the instruments you need, the products you need, and the service you need. Somebody asked earlier about how much do people charge in commission. You'll find anywhere from less than $1 a trade to $20 a trade and everything in between. You don't want to go with the cheapest. You don't want to go with the most expensive. Our brokerage charges, depending on account size and volume and that sort of thing, most of our online traders are paying about $6 round turn plus exchange fees. That covers both sides of everything. But we give a lot of service with that. We give trading recommendations. We help them if they get into margin trouble. We give them advice. We're here for them. You can find cheaper, but you're probably not going to find a better value. But again, shop around, make sure you're trading with someone that you're comfortable with. So in conclusion, for those that are looking to day trade with lower risk, less stress, and without the limitations of being completely flat by the close, weekly options could be the answer. There's low barriers to entry, there's no margin, there's limited risk. Overnight risk is optional. Just because you hold into the close doesn't mean you have to hold throughout the night. You can get out of your position before you go to bed. So you don't have to have a position open while you're sleeping, but don't get out at the close with all the other sheep. It's really a tough game to play. No premature stop outs, no runaway losses. You have lasting power. You're not going to see the huge quick drawdowns that you might see when you're trading futures. It forces you, option trading forces traders to have more patience, and it reduces the noise and stress, which lowers the probability of emotional decision making, and people that make decisions under emotional duress are making poor decisions on average. We're DeCarli Trading. We're a futures and options brokerage firm. We would love to hear from you. If you have any questions, feel free to contact us. You can visit our site, decarlitrading.com. And if you're interested in learning more, these are the 2 books that we would recommend. I'm in the process of writing a book as we speak, but it probably will not be out until early next year, and it will be specifically on option trading, solely on option trading. Here's my contact information. If there's anything we can do for you, you can reach us here. DeCarliTrading.com. There's my phone number. There's my email address. We'd love to see you on social media. Okay, I appreciate everybody coming out. I hope you learned something. Again, visit DeCarliTrading.com if you want to learn more. and we'd love to hear from you. So if you have any questions, let us know. Thank you.